Hello, everyone, and welcome to today's Lunch and Learn live webinar presented to you by ABC Financial Group. For today's session, we'll be discussing why business structure matters, an analysis of sole proprietorships, LLCs, and S-Corps. For today's session, your hosts are founding partners at ABC Financial Group, Zakia Ballard and Waysu Cobb Phillips. Together, they serve as part-time CFOs for growing and established firms and small businesses nationwide. With over 30 years of experience between them, Waysu and Zakia lead a team of accounting and tax experts from bookkeepers to CPAs. At ABC Financial Group, we strive to take the stress out of money management, giving business owners the freedom to invest time back into the growth of their company.
Hi, everyone, and welcome. First, I want to say how excited we are by all the positive feedback we've received about our Lunch and Learn series. So we're going to keep it going. If you have a topic you would like us to discuss, drop it in the chat and let us know. It just may end up on one of our next webinars. With that being said, we're really glad you decided to spend this hour with us as we discuss everything business structures. If you already own a business, you're thinking about starting one, or you've been saying, I'm going to get to this business one day, this conversation is definitely for you. Should you be a sole proprietor? Do you need an LLC? Should you elect S-Corp status? And what does any of that actually mean when it comes to your taxes, your accounting, and your personal finances? Well, one of the things we see all the time is entrepreneurs making these decisions just based off what somebody else did. You hear things like, just get an LLC, or once you start making money, you must become an S-Corp. Or an LLC means nobody can come after me personally. And one of my favorites are, if you have an ENN, you must be a business. Some of these statements have a little truth buried in them, but they're missing a lot of context. And that's basically what we're going to add today. The right structure depends on things like how much you're making, whether you have partners, what type of business you're operating, your risk, your growth plans, and your tax situation. So by the end of today's webinar, we want you to understand the major differences and most importantly, know what questions you should be asking to your legal team or accountant. Please note that this webinar is for general education purposes only. Your individual legal and tax situation may be different, so you should book a discovery call with us before making any decisions about your business structure. So why does business structure even matter? Your structure can affect many areas of your business. One is how your business income is taxed. Your structure determines where the profit is reported and in part, what taxes may apply to that profit. For example, a sole proprietor and a default single member LLC generally report business on the owner's individual federal tax return, on what we commonly call a Schedule C. A partnership generally passes income through to its partners. An S-Corp also passes income through to its shareholders. But a shareholder who works for a business generally must receive reasonable compensation. A C-Corp is totally different from all of those. And because the corporation itself generally pays federal income tax, so do its shareholders. So that's why people usually say it's part of the double taxation. The important thing to understand is that making $100,000 in profit doesn't necessarily mean that that $100,000 will be taxed exactly the same way under every business structure. And how you're structured helps determine where that income is reported and which taxes may apply. 2, what tax returns you may file. Will it be a Schedule C, a Form 1065, or 1120? Forming an LLC doesn't automatically mean you file a separate federal income tax return for the business. And as I said before, single member LLCs usually report their business activity on the owner's individual tax return. The third way it impacts is how you pay yourself. A sole proprietor generally doesn't put themselves on payroll as an employee. They just take money from the business as an owner's draw. Similarly, partnerships work in the same way. They may receive distributions or guaranteed payments. An S-Corp works differently. The IRS generally requires the corporation to pay wages for shareholders who work there. That means payroll becomes important. The fourth way it can impact is your administrative requirements. Generally, the more complex your structure becomes, the more compliance you have. A sole proprietor may have very few requirements, where an LLC may have state registration requirements or annual and periodic reports, while an S-Corp can always think payroll and payroll tax filings. Sometimes people focus entirely too much on how the entity can save them in taxes, but we also have to ask, what will it cost you to properly maintain that structure? The fifth way it can impact you is your accounting responsibilities. Technically, every business needs adequate records, of course, but the complexity and importance of the accounting process usually increases as the business and its structure becomes more complicated. Then we have to also consider how you would bring in partners and investors to your business. Are you building a business that you plan to own yourself for the next 20 years? Or are you building something that will eventually want investors to put money into? Those two answers can lead us down very different roads. And then finally, we have your exposure to certain business liabilities and potentially how much you pay in taxes. They're both very much affected by your structure. So remember, creating a business and deciding how that business will be taxed are related, but they aren't always the same decision. For instance, an LLC is a legal entity created under state law, and an S corporation is a federal tax election. So you could legally be an LLC while electing S corporation tax treatment. That's why understanding the terminology matters. Now, Wei-Su will explain the different types of structures and their key components.
Thank you, Zakia. Let's get started. One of the easy structures to do is a sole proprietor. So you woke up one day, you said, hey, I'm going to start a small business selling homemade goods at a farmer market or dog walking services or freelance consultant. You charge your first client $1,000 for this assignment. They pay upon completion with a check. The funds are deposited into your personal bank account. Congratulations. You've just created a sole proprietorship business without any additional government paperwork. Sole proprietor is the simplest legal structure to create. The structure is based on your full legal name and your right to work in the United States. The business income and expenses are reported on your Schedule C, with the gross revenue from the business expenses included in your personal tax filing. This is the simplest structure, but also with the highest potential liability because there is no difference between you and your business. A deviation to this, which you also hear people say, is I have a DBA, doing business as. And what this is it is a sole proprietorship with a name or a fictitious business name or a nickname. For instance, my name is Wei-Su Cobb Phillips. If I want to start a different business and I want to use my name or using a DBA, I can have a fictitious name to create it. It could be Phillips dog walking service. It's still a derivative of my name, but it's now a DBA. This is still a sole proprietorship, but now you have a name out front, a moniker, so to speak. The DBA is supported by EIN number instead of your social security number, but the EIN number is linked to your personal information. And just like the sole proprietorship, which uses your full legal name, the DBA is still taxed at the individual tax rate, and you are still personally responsible for any income or liabilities derived from that. And all things are reported on your Schedule C. There's a few legal paperwork for the DBA, but not much. Normally, it's just filing a statement of fictitious business name exempt with your local county office. Next, we have the most common, we hear people say all the time, I'm going to get an LLC. Well, you say, after consideration, hey, I want to be more than sole proprietorship. I want to be protected. So generally, people think the next entity type is a sole proprietorship, which is true. So, LLC. But if you're a single member LLC, is one thing to be considered. It is definitely at the state level a separate entity, but at the federal level, a single member LLC is what we are known as a disregarded entity. So at the federal IRS level, the single member LLC is taxed the same as a DBA sole proprietorship. That means it is taxed on your personal taxes, and there is no differentiation between you and the business at the federal level. At the state level, you are a separate entity. So the state, once again, recognizes you as a separate entity, so it allows you to open up bank accounts, sign contracts, incurs debts. You can be sued separately from you individually as part of the DBA. This generally also requires you to file an annual filing fee, a tax return, and some state tax liabilities related to the LLC. But a single member LLC, what it does do when properly executed and documented, it protects your personal assets only to respective separation. And the key part about it, and what we mean by that is, are you truly treating the LLC as a separate entity from yourself? And one of the things we talk about for clients is, hey, if I have an LLC, not to pay personal expenses using an LLC debit card and a business card, and not to pay business expenses using your personal funds for the LLC, because at that point, you what's called pierce the corporate veil, and you wipe away any legal protections. So once again, a single member LLC can provide protection at the state level if properly maintained and documented. The next level is where we truly start seeing the full breadth of the LLC is a multi-member LLC. Now, a multi-member LLC means just that. There is one general member who has unlimited liability, meaning they're not protected, and any number of limited liability partners. So if I'm an LLC and I have 5 partners, one partner must be the general partner, meaning they take the brunt of the liability, and the other 4 can be limited liability partner. The key part about it, each partner receives a share of the income and business loss based on the percentage of ownership. They also they can be sued or held accountable for any litigation up to the percentage share of their business income and loss percentages. So once again, use the same analogy. If we have 5 partners, I as the general partner own 50%, and the remaining 4 partners own 50%. If we are sued, there's unlimited liability. Each partner is owed up to their general liability amount, and the general partner is owed has unlimited liability. So limited partners can have their much up to their percentages, and the general partner unlimited. So it's very important to understand what that is. But in the multi-member LLC, if done protection, is at the federal level, a income reporting entity type with no tax consequences, and each income and loss is deducted by the members at the individual tax basis. So the idea is the LLC reports income to the IRS and then distributes the K-1 or the reporting income to the members for them to report at their own personal tax tax basis. The next thing is the S-Corp. And there are two different ways of doing an S-Corp. There is the conversion of a single member LLC into an S-Corp, or there is the creation of a corporation and converting it down to an S-Corp. And what I mean by the first type, I'm a single member LLC. We talked about a disregarded entity, but I want to be treated as an S-Corp. So I make what's called an S-Corp election to treat an LLC as an S-Corp. And what that means is now that LLC is created at the state level as an LLC, but at the federal tax level, it's treated as an S-Corp. So you still have state requirements of an LLC, but from federal tax purposes, I'm treated as an S-Corp, and I will file my own tax return for the LLC treated as an S-Corp. For the conversion from a C-Corp to an S-Corp, it's saying, hey, I've created a typical corporation, but I recognize I want to have shareholders who are known, so I'm going to convert down to an S-Corp or a subchapter S corporation. Both entity types, whether the LLC converted or the C Corp converted to S Corp, must follow the same rules. And what that means is limited number of ownership. So with an S Corp, you can't have more than 125 shareholders, regardless of your entity type. So if you're planning on, say, hey, one day I'm going to have 200 investors, maybe an S Corp is not the right entity type for you. And or you say, hey, I'm only going to have one investor, the S Corp may be the right entity type for you. But one of the requirements of an S Corp is you still have to have payroll for the shareholders and operations. And so there's something to consider as part of that calculation. Sometimes you may say, hey, I'm not sure if I'm going to do payroll. An LLC may be something I want to keep as my factor, but we want to talk about potentially having payroll down the line, then the S Corp may be part of that conversation. The other part about the S Corp conversation into consideration, it itself does not pay taxes, and the member itself are only responsible for paying the payroll taxes on monies owed. Whereas an LLC, potentially, you're owed self-employment tax on the income at the personal level. So the tax considerations for each entity type may factor in how you convert your idea. With this, I'm going to give it back to Zakia, next on business myths.
Thanks, Oisu. So yes, let's talk about a few common business myths. The first one I have is an LLC is always the best business structure. We definitely hear this all the time, and that's false. An LLC can be an excellent choice, but we're accountants. We don't like making financial decisions using the word always. Things change. So the appropriate structure really depends on the business. A freelancer earning $15,000 on the side may have different needs from someone who's operating a business producing $500,000 of annual profit. And those two people may have completely different liability exposure, employees, partners, and growth plans. The second myth we hear is my LLC means I can never be personally responsible for business losses. This is a dangerous one. Creating an LLC can provide important layer of liability protection, but it isn't a magical wall that makes every personal risk disappear. Personal guarantees on loans, certain personal actions, and commingling business and personal finances, failure to maintain the entity properly, and other circumstances can definitely affect that protection, which is another reason we tell business owners, separate your finances. A business account and a personal account are two different things. So buying groceries, paying personal utility bills, and getting your hair done, and then saying my accountant will figure it out, are things you shouldn't do. Yes, we probably will figure it out, but we're going to have a lot of questions, which is going to require a lot of time for you, and we're going to need to spend more time on your books than needed. The third myth is my accounting doesn't have to be perfect because I'm a small business. This is probably the myth we want to spend the most time on, because small business doesn't mean casual accounting. Your accounting tells you what's happening inside your company. So you should be able to always answer basic questions. Are you profitable? How much cash do you have? What do customers currently owe you? What do you owe your vendors? And how much should you be setting aside for taxes? Which part of the business is actually making money? These become especially important when you're considering changing your entity structure. Because if your books aren't accurate, how can you make decisions about changing your tax structure? It actually has to make sense financially. So bad numbers create bad strategy, unfortunately. Wei Sue?
Thank you, Zakia. Let's piggyback off of that. Bad numbers create bad strategy. Choosing between an LLC and an S-Corp is not a one-size-fits-all decision. The optimal selection depends heavily on your specific operational activities, what income you're going to do, and the owner's partner payroll requirements. And that's a key part of that: owner's payroll requirements and compensations. So with an LLC, which is we talked about previously, a disregarded entity, a single member LLC, you are subject to self-employment. And the key part of that, self-employment is 15% of the gross revenue, regardless of profitability, you're owed on your taxes. But at the same time, an LLC can be an excellent structure for owning real estate and understanding what that looks like. And owning real estate. So an LLC owning real estate does not automatically trigger capital gains taxes on appreciated property. So if you plan to purchase real estate for development and sale, or purchase real estate as rental property, an LLC generally may be a better entity type. However, on the flip side, I plan to purchase real estate and operate a management company, which may have employees and things of that nature. So then I may want to open up an S-Corp as a different real estate type. So what business activities you plan to have may determine your entity type. And what you do today, and this is the key important, what you do today may not necessarily be what you do in the future if tax laws change and adversely impact one entity type over another. If you say, hey, I'm going to choose an LLC as an entity type, and I'm not going to choose payroll for my employees, but I'm not going to pay payroll for my members, but I'm going to pay my employees, and I'm going to own property, then the LLC is perfect. But in that same vein is, hey, but I'm getting older and I want to be on payroll. I want to pay myself. I'm tired of paying self-employment tax. Then I may want to look at converting to an S-Corp. Well, then the key component with the S-Corp, the IRS says an S-Corp must pay its shareholders who have operational wherewithal a reasonable standard for your business. The key part about reasonable, the IRS will then use comparable businesses of your type to determine what's reasonable. And they do not evaluate based on whether or not you have cash in the bank. So we have some clients have said in the past, hey, I'm an S-Corp. I have not been able to make my payroll this year because my business has been slow and therefore I'm not going to pay myself. And we let them know that's not allowed. The IRS has determined that reasonable payroll has nothing to do with cash available for operations. So in that factoring, hey, I'm going to be an S-Corp. Can I consistently make payroll for my business, including me as an employee, for the perpetuity of the entity type. So if I'm going to buy, once again, use the analogy, buy real estate just to hold real estate, I may not want to be an S-Corp because I'm going to hold an asset and probably nothing else. But on the flip side, if I'm going to buy and hold and collect rental income for a property, which is going to generate activity, maybe I should be an S-Corp and provide reasonable compensation. And with that reasonable compensation, what you now have done is you've deflected the self-employment tax away from you as the shareholders into payroll tax. And the reason why that's important is your payroll tax typically, not always, is typically less than your overall net income tax or self-employment tax from your operations. For example, if I pay myself $100,000, my payroll tax is about 15%, which is about $15,000. If my net profit is $1 million, and it gets 15% self-employment tax is now $150,000. With an S-Corp, because you're only really paying payroll tax, because the S-Corp, once again, is not a taxing entity, you're avoiding self-employment tax. So the entity structure and type really depends on, hey, what are my activities now and in the future? What do I plan on doing for me through payroll, both as an employee and as an owner of the business? Do I plan on owning real estate? Do I plan on purchasing capital assets? Do I plan on doing operations for the business? What entity type that looks like. Sometimes it may be you may have multiple entities for different parts of your business. So you may have an LLC to own real estate, an S-Corp to operate the business. You may be a sole proprietor that converts into a LLC that maybe converts into an S-Corp. So the entity type is not one size fits all and is not set and then forget it. Electing an S-Corp and LLC should be evaluated in the beginning of your business as well as business has significant changes. Thank you.
So this brings us to one of the key takeaways from today's webinar, in my opinion, which Wesu has already said. Your business structure should not necessarily be a decision you make once and never revisit. You should consider reevaluating your structure whenever something significantly changes. So your business becomes consistently profitable, and or your revenue and profit increases significantly. You add a partner, you hire employees, you expand to a new state, or you decide to add a new business line. You are considering outside investors, or you're preparing to sell your company. Or you're simply not sure if your current strategy makes sense to you. We especially recommend reviewing this before year end. Don't wait until you're sitting in your pre-tax meeting with me in March and April and ask, what can we change for last year? Some strategies require action during the tax year, and planning at least gives us options. So let's bring everything together. If there's one thing we want you to remember from today, it's that there's no universal best business structure. There is a structure that may be appropriate for where your business is today, and that structure may change as your business grows. So being an LLC does not automatically mean you're taxed differently. Having an EIN doesn't automatically change your entity type. And electing S-Corp status doesn't automatically mean you're saving money. And none of these structures eliminate the need for accurate accounting. That's why we need business owners to stop looking at accounting and taxes as something you deal with only once a year. The way I like to describe it is your bookkeeping tells us what happened. Your accounting helps us understand what it means. Tax planning helps us decide what we can potentially do about it. And business advisory helps us determine what comes next. And we have services that address each of these scenarios. So here's the question we like to leave you with. Is the business structure you started with still the right structure for the business you're building? If you don't know the answer, that's okay. But that's probably a conversation that's worth happening. And that's exactly the type of conversations we have with our clients daily. We look beyond simply filing tax returns. We look at your accounting, your business structure, your tax position, your goals, and where you're trying to take your business. And truthfully, sometimes the answer is you're fine exactly where you are. Sometimes it's we need to start planning for S-Corp election. And sometimes it's before we talk about changing anything, we need to clean up these books. Which is also why individualized advice matters. Two businesses can make the same amount of money and still need completely different strategies. So schedule a consultation with our team and we'll help you take a closer look at where your business is today and what steps you need to take to get it where you want to be. And again, thanks for spending time with us today, and we hope to see you at our next Lunch and Learn webinar, Business Budgeting and Forecasting Made Simple. Thank you.